Something strange has been happening in Dubai real estate, and if you're not watching closely, you're falling behind. Right now, the Dubai property market is doing what it does best, keeping everyone guessing. Prices are rising, sure. Rent is still solid, yes. But underneath that, I'm seeing patterns. From the clients I work with, from the launches I track daily, and from the numbers that actually matter. This market is shifting and evolving. We've got shrinking unit sizes, oversupply creeping into certain segments, investors preferring alternative locations to the past all-time favorites, and developers doubling down on payment plan psychology, not actual product quality. At the same time, capital is still pouring in, but it's not the same capital. It's smarter, quieter, and more strategic. It's like Dubai has chosen the old money style. In this video, I'll show you what I observed, the winners, the losers, and where the next opportunity will come from. And by the way, my name's Gorasov. I'm a property investor, not an agent. I'm not affiliated to any developers whatsoever. I run my property management and investment company, Agora Homes in Bali and Dubai, and Agora Advisory, an investment advisory company in Dubai. So you'll hear the real take, investor to investor, not brochure slogans or clickbait hype. Just the truth, backed by data, and lived through my day-to-day investor life and conversations I have on a daily basis with my community, specifically serious investors moving money into this market. Hit the thumbs up button, subscribe, and let's get into it. Let's start with the bigger picture because numbers never lie. According to Radin, Dubai's residential price index rose by 15.6% year on year. Apartments are up 15.2% and villas are up 17.8%. That's impressive. But it's not as aggressive as in 2023 or 2024. And the momentum is clearly decelerating. Now, from DXB Interact and DLD, a 23% increase year on year. Total transaction value is at 262.7 billion dirhams. That's a 38% jump. Still bullish, but what's interesting is that it's shifting. Let's talk winners, and there are a few standout trends. First of all, these are the villas in prime location. Villas are absolutely leading, and transaction volume is up 55% year on year. And ready villas sales nearly doubled. I've personally seen some of my clients rushing in areas such as Dubai Hills Estate, Al Furjan, Palm Jumeirah, and even Damak Lagoons. And you'd ask why? Interestingly, that's because the work from home culture hasn't really disappeared, and many of those clients actually prefer to work from home and they need a larger space. People don't only want the space, they want privacy and lifestyle. Ultra luxury is also still hot, but different. It's not the same hype-driven wave as it was in 2022. Buyers now want uniqueness, not just a Burj view. They're looking for limited stock, beachfront, branded, and architectural significance. Anything that makes the unit irreplaceable. Rarity is driving value, not marketing fluff. And finally, mortgage buyers are back, and they are back in full force. That's another huge shift because many more buyers are now preferring mortgages. And I'm not only talking about people who can't afford to pay upfront. I'm actually talking about very wealthy investors and buyers who simply don't want to lock all that money into one property. And why is that happening? Well, because the rates are stabilizing between 3.95 and 4.4% fixed on 3 years. And owning is finally becoming cheaper than renting. I've also noticed that a big number of my clients are setting up their companies in Dubai, not just investing in property. Moreover, that's not for tax or visa-related purposes, but to operate remotely from Dubai and plug into the ecosystem long-term play. That's a big mindset change. Now, let's talk about the losers, or let's call that the vulnerable spots that are losing momentum. There is a clear off-plan price fatigue. This is real. In Business Bay, off-plan units are now being sold at an average 44% premium, and year-on-year price growth on off-plan there actually -1%. Developers like Benghazi, Ellington, Danube, they, at least in my opinion, are launching too fast. And while I'm not saying they are launching bad projects, I actually like them and I would be looking to invest in them. Many of them have shrinking size units and aggressive payment plans, which doesn't make it easier for most investors. From what I've seen, the floor plans are getting tighter with every single launch. Studios used to be 450 to 550 square foot. Now they're barely touching 380 square foot. And buyers are starting to question the value. Of course, that's dangerous for long-term performance. There are also overexposed mid-tier zones. Places like JVC and Arjan are still seeing deliveries, but it's relentless. JVC alone is set to deliver 27,000 units by 2028. That's some serious supply, and if you're one of those investors, I have no idea how you will be competing with all those other landlords in the area. And again, I'm not saying it's too bad. I mean, if you got it with a really great price per square foot, then good for you. You will probably be seeing some good ROI, even with that creeping supply coming into the area. But if you simply got it on the marketed prices that we currently see, you most probably will be losing there. We're already seeing listings being stacked up on Property Finder. Due to this supply, renters and buyers are spoiled for choice. In a rising supply environment, only the best of the best buildings and the best locations will hold value. So what investors are doing differently? Here's something I've noticed from my own advisory clients. More capital is indeed coming to the UAE, but not casually. And why I said UAE? That's because it's not just Dubai. People are actually shifting towards other places, and specifically Abu Dhabi. Most of these are portfolio investors, not just buy one unit and wait to see if the hype works out for you. They're looking at IRR, leverage strategy, entity setup, and multi-asset exposure, and they are contacting professionals, including our company, to help them strategize and visualize how to do it correctly for their long-term personal growth, and most importantly, company growth, because many of them are actually setting up companies to run these properties altogether. Today's investor is much more smarter, more structured, and looking in the long term. I mean, they're not speculating anymore, and that's exactly why they are looking in the long run. Like I mentioned, Abu Dhabi is also getting much more attention and many more better quality projects in. Actually, most of them are sold out for real. I am literally trying to find a few properties that would make sense, and they're completely sold out. If we're talking about off-plan, I can't really get anything. It's not just from the media, it's from my own clients and for my own investments. I've had more inquiries into Saadiyat, Reem Island, Yas Island in the last 3 months than in the entire past year. So it's no longer just about Dubai, which obviously is the king and is continuing its growth, and I will definitely prefer that for now. But many are actually shifting and looking at other areas, and that includes me. Because diversifying your portfolio, especially if you don't just hold one property or even 2 properties, you have more, it's really smart and it will work out for you much better in the long term, especially when we compare Dubai to Abu Dhabi even. In Abu Dhabi, you can definitely find much more and better supply for a fraction of the Dubai cost sometimes. Nevertheless, for Dubai, I think the rental ready market is still the best. There are so many units that you can now get already ready and even furnished, and even with the tenants being in and paying for the rent. I've recently also sold one of my properties, which is already rented, and the new buyer, well, the new landlord is actually going to receive the profits right away. So why not get into this kind of segment and profit right away? This leads into the next point. Despite new supply, rents in Dubai and the yields are still super strong. Apartments on average at 7.2% gross and villas around 5%. And that's of course if we speak about the really average on cash investments. Obviously, for mortgages, like I mentioned in many of my previous videos, this percentage will be way higher. But with rent growth slowing from 21% in 2024 to just 8.5% in May 2025, yields are likely to compress unless the entry point is really smart. In Abu Dhabi, it's the opposite. Rents are booming with 27% increase year on year, and with the apartments leading this charge. And while I still prefer Dubai for the long-term rental market, as there is less available supply for rent in Abu Dhabi, there are less developers building in there, and it's harder to get really good units in there. I can see the trend shifting and I would like to be part of it. So diversifying and managing it properly and making sure that you do your due diligence right and you understand where you buy will actually be quite beneficial, at least in my opinion, in Abu Dhabi. One big shift in 2025 is that the developers are also bringing construction in-house. MR, Samana, Azizi, and even Ellington are building their own contracting arms. So why is that happening? To cut costs, to control timelines, and of course unlock faster cash. But as I always say, when developers are trying to do everything by themselves, quality control can either suffer or really become very good. So we don't really know what to expect. There's also some risk. If demand dips, they're left with empty factories and idle teams, and they will probably have to sell more of their inventory at cheaper prices just to be able to cover those costs. And by costs, I mean the salaries for all the people and all the materials involved as well. Here's what I believe it's coming next. Prime assets such as beachfront limited editions will always hold the value and grow further. This is the same as buying a very limited edition Rolex or any other watch brand from the very respected Swiss brands that will always keep the value and continue growing. Doesn't matter what the market would do. There's generic off-plan oversupply in some of the areas, which is risky. A correction, maybe, but definitely not a crash yet. But yes, some mid-tier projects will definitely see and have some pressure. I expect actually more investors to enter, just through different structures, way smarter. Holding companies, portfolio leverages, and visa residency tied to investments. I know for a fact there are many investors who hold the cash and will wait for those opportunities to appear when any kind of corrections will happen, and they will buy in bulk. If rates stay stable and global money keeps flowing, we're still in a good place. But this is no longer a predictable rising tide, so we really need to know and to assess what is going in this market to be able to confront it properly. So what's my advice to you? If you want to enter right now, you need to be strategic. Don't just chase launches blindly. Don't buy based on floor plan art and to impress friends back home, because trust me, I've heard that. Understand PSF or price per square foot, compare it to ready units or at least to other off-plans in the same micro area. Check rental potential and most importantly, know your exit. You have to know it before you buy. If you need help for buying, refinancing, or simply want someone to break down the real-world projects happening and the options available in this market, I can help. This is what I do daily with serious investors and serious portfolios. But my time is limited physically, so you need to book your calls in advance. And if you want to get into any of the advisory services that my company Agora Advisory provides, then check the links in the description, reach out to me directly, book a one-on-one call, or just simply email me at business@alexgorasov.com and let me help you make your move in this market the smart way. And with that, I thank you for watching this video. Please, as always, leave a thumbs up if you liked it and subscribe for more of these videos in the future. And with that, I will see you in the next one.